As of right now, the stock market is officially closed for the session. The final trading figures for BigBear.ai show the stock closed at $3.53 per share on Thursday, July 2, 2026. This represents a distinct intraday drop of 3.02%, shedding 11 cents from its opening baseline as the broader enterprise tech sectors faced variable selling pressure across the board. Total volume for the session recorded 24.13 million shares changing hands, which reveals a mild slowdown compared to its longer-term 3-month daily trading volume of more than 31 million shares. Now, while many casual retail investors looking at this single-digit ticker might assume that this government-adjacent software operator is simply experiencing routine low-priced volatility, the raw technical reality hiding beneath the daily tape points to an entirely different corporate story. The immediate surprise here that almost no one is talking about is the quiet consolidation of institutional block trades showing up in dark pools over the last 2 weeks, suggesting that while the public price action looks weak, larger funds are systematically setting up positions ahead of the upcoming federal fiscal cycle. This sets up a profound curiosity loop because it implies the public market narrative is entirely disconnected from the institutional accumulation strategy. When people log on to modern investing sites to check up on their capital, the common belief surrounding this particular asset is that it acts as a highly speculative, high-beta vehicle designed purely to ride the coattails of giants like Nvidia stock. The expectation among small retail accounts using a standard individual brokerage is that any minor headline regarding algorithmic intelligence or federal defense budgets will automatically push this equity up to 20 or 30% overnight. Investors expect immediate explosive growth because they treat it as a direct proxy for the wider enterprise data landscape. But the reality is far more clinical and challenging. The company is operating under the heavy constraints of long-term government procurement cycles where contract awards take quarters, if not years, to fully hit the balance sheet. This creates a severe mismatch between the instant gratification expected by modern-day traders and the slow, grinding reality of federal software integration. If you are approaching this asset with the mindset of someone buying Apple stock or Tesla stock for stable corporate earnings growth, you are fundamentally misreading the structural architecture of defense technology providers. Looking deeply at the recent price action over the past month, we can see a clear trend of systematic distribution punctuated by sharp, high-volume rallies that quickly run out of steam. The stock has spent the better part of the last 30 days oscillating within a defined horizontal corridor, testing its 50-day moving average multiple times only to face rejection from institutional sellers sitting at the upper bounds. Trading volumes during the down days have consistently remained below average, which often indicates a lack of aggressive capitulation, but the up days have seen massive spikes in volume that fail to sustain their gains through the closing bell. This indicates a high level of algorithmic scalp trading rather than long-term buy-and-hold commitment. Institutional activity reports suggest that while hedge funds are utilizing options contracts to play the short-term swings, standard asset managers are keeping their exposure relatively flat. The macroeconomic backdrop is not helping either, as persistent high interest rates continue to drain speculative liquidity out of small-cap tech names, forcing capital back into secure large-cap balance sheets. When you examine how individual investors handle this asset across popular retail networks like the Robinhood app or through SoFi investing channels, you notice a massive divergence in portfolio construction. Users utilizing a basic individual brokerage account tend to buy small chunks of shares on sudden momentum, while those managing their capital through platforms like Schwab Intelligent Portfolios or a comprehensive interactive brokers platform are approaching the position through automated risk-managed frameworks. If you are looking for investment help regarding small-cap tech, the first thing to recognize is that companies with negative earnings per share require a much higher level of self-investing discipline than blue-chip equities. Many retail traders look to standard investing sites for quick tips, but Managing a position in a volatile defense software firm requires understanding how order execution works across a specialized interactive broker's account or a premium fidelity brokerage. The fees associated with trading low-priced equities can add up if you're not careful, especially when using institutional tools like the Interactive Brokers Trading Desk or setting up automatic rebalancing rules inside an intelligent portfolio. To truly comprehend where this asset is headed, we must look at the actual operational numbers from their recent first quarter report for 2026. The company reported a loss per share of 12 cents, which was notably wider than what the consensus of Wall Street analysts had estimated. Even though revenue hit $34.44 million, beating the conservative expectations by about 2.5%, the bottom line loss widened due to escalating research and development costs alongside the heavy integration expenses of past corporate acquisitions. Investors using a Fidelity mobile app or tracking their holdings through Robinhood stock trading saw the stock initially tick upward in after-hours trading following that report, mostly because the top-line beat offered a temporary sense of relief. However, the subsequent normal trading sessions quickly washed out those gains as the reality of structural unprofitability sank back into the market consciousness. Operating expenses surged to nearly $25 million for the quarter, highlighting how expensive it truly is to maintain bespoke software solutions for complex clients while trying to scale up a commercial product line simultaneously. Let us step back for a moment and define exactly what this enterprise does to generate its top-line revenue. The company specializes in providing cloud-based data analytics, machine learning software, and decision support systems primarily tailored for the United States Department of Defense, national security agencies, and highly regulated commercial sectors. Their business model relies heavily on long-term government contracts, which offer predictable revenue backlogs but suffer from intense regulatory oversight, strict compliance costs, and the constant risk of federal budget reallocations or continuing resolutions in Congress. Their technology stack ingests massive amounts of unstructured data from disparate sources, blending imagery, communications, and logistics streams into a cohesive operational picture for defense commanders. Over the past couple of years, the firm attempted to diversify its base by acquiring entities like Pangiam to build out their presence in commercial identity verification and aviation security, trying to move away from being a pure-play government contractor. Historically, the firm emerged from a blank check shell merger during the peak of the recent market boom, a structural origin story that left them with a legacy of high share dilution and substantial debt obligations that continue to weigh on their net income potential today. Moving into the future outlook, the trajectory of this equity will be defined by how successfully management transitions from custom consulting work to high-margin software licensing. If the federal government expands its spending allocations for autonomous defense systems and national security infrastructure, the company could see an accelerated cadence of large contract announcements, which would act as a powerful catalyst for the share price. On the flip side, if macro pressures force a reduction in discretionary defense tech spending, or if larger competitors with deep pockets muscle them out of major contract renewals, the downside risk to the current valuation remains significant. Retail participants using modern tools like Fidelity mutual funds, Robinhood investments, or SoFi ETFs should keep a close eye on the contract backlog figures in the next quarterly report, as that metric provides the truest signal of long-term corporate health. For anyone engaged in online investing activities, balancing these highly speculative assets alongside conservative assets like Fidelity ETFs or allocating capital via a managed SoFi robo-advisor is crucial for overall portfolio stability. Comment below how many shares of BigBear.ai you currently hold in your portfolio and let me know if you plan to buy this dip or sell your position. Ultimately, when we look at the total landscape of online investing today, the expectation that this asset will easily follow the trajectory of massive market leaders remains a highly dangerous assumption. The reality is that this is a niche, specialized defense software firm navigating a complex path towards baseline profitability amid intense competition and challenging macroeconomic conditions. Whether you choose to execute trades through the Fidelity trading platform, manage your crypto and equities side by side on Robinhood Crypto, or utilize the advanced charting capabilities of an interactive broker's stock trading account, success requires decoupling your decisions from social media hype. True wealth accumulation through self-investing relies on analyzing hard financial metrics rather than chasing short-term momentum. As the market prepares for its next opening bell, keeping your focus anchored on real operational execution, revenue retention, and margin expansion will separate the disciplined market participants from the speculative gamblers. Understanding the internal dynamics of asset allocation means recognizing that an investment in low-priced tech names cannot be handled with the same passive compliance as broader index funds. When checking your portfolio performance on a standard individual brokerage interface, the daily swings can look dramatic, often inducing panic or false optimism. The institutional desks running high-frequency algorithms look at these retail reactions as liquidity events, exploiting the gaps between public expectations and structural realities. If you look at how large wealth managers handle these situations, they rarely